your son. Won't say it won't go down. I'm a winner, I can feel it in the city, yeah. Heavy when I'm breathing in it. Roll the dice for the 7, hit 11, hit a 7, hit 11 again. I'm all good. Got a 4-leaf clover. Y'all can knock on wood. It's my lucky day. 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 'Cause I know today it's gonna go my way. I can see the sunshine through the rain. It's my lucky day. Yesterday I got burnt. Today I'm so tan. I was late to work. On a day my boss slept in. I got an overdraft. Till this morning I got paid. The devil can't stop me. I woke up feeling sad. I'm a roller on the table in the game. It's the all-time unbeatable head. No, heavyweight in the ring. It's the creed. It's the all-time unbeatable man.
Good afternoon, ladies and gentlemen, and welcome to the HOSTMORE Preliminary Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to CEO Robert Cook. Good afternoon, sir.
Good afternoon and a warm welcome to the inaugural HOSTMORE annual results. If I can start by taking you through the highlights of 2021. So we saw, one second, we're just, okay, so we're on the highlights page now, great. We saw strong demand evident from May 21 when the government lifted the restrictions across, I was about to say across the UK, but across England. We saw like-for-likes from May 19 to end of year up by 4%, which included the impact of the output VAT rate change from 5 to 12.5% on October the 1st. We were able to kickstart our organic growth program of opening stores. We opened 4 stores in the year just gone. Lincoln, we saw the first of our new Friday stores open, and we saw the launch of our fledgling brand 63rd and First, which you saw in the video footage there in Cobham, Glasgow and Harrogate. We had a strong balance sheet and liquidity, and net debt reduced further to 12.2 million. And I'd like to say at that point, that was all through free cash, unlike many we did not, or trigger other mechanisms in order to do that. And we go into 22 well positioned for expansion. 6 new stores openings in 22, 3 core brand in Barnsley, Durham and Chelmsford opening on the 27th of April. 2 more 63rd and Firsts in Cambridge and Edinburgh. And the first in the world of Friday's fast casual brand, Fridays and Go, QSR opening in Dundee on Wednesday of this week. So very excited about that as we enter the week. We'll also, as we said in both our CMD and our prospectus, exploring non-organic opportunities to look at fledgling brands looking for capital to grow. Although in that respect, we are quite patient and we are waiting to see if there is, as we anticipate, a fallout post the rent moratorium ending, business rates coming back into play, and VAT going to 20%, added to the obvious national minimum wage coming into play. If we go next to the current trading environment, so we're seeing demand profile has differed by store type. Retail parks, 31% have outperformed in 19. Our city centre, of which we have 15 stores, and our stadium venues have naturally been quieter, particularly our stadium venues where there's been lack of events. Our trading is also different between regions. North East and Scotland, where we have 16 stores, have outperformed against 19, even with the excessive restrictions still on in Scotland around face mask wearing and offices not allowed to return to work or not being advised to return to work yet. In the north, where we have 15 stores, and the southern region, 14 stores, have been quieter. The like-for-likes for the 8 weeks ending the 27th of February, adjusted for stadium venues, is 3% lower than FY19. Now, there is some explanation to do there, of which the first thing I would say is that dine-in is consistent with the wider market for the first 8 weeks of trading. Where we are behind the market is in dine-out, and we're lower than the comp set in that particular area, so delivery. That is because we focused on quality of revenue, and knowing that in delivery, you first of all are discounting against your store, and also the third-party aggregator costs that come with that. So we've been very focused on the quality of revenue. We are also, for us, Friday and Saturday night is sacrosanct in store. Our 87 stores across the country perform at its highest, Friday, Saturday and Sunday, and we've been protecting that in-house traffic rather than opening up to the delivery aggregators. And then finally, we are, however, seeing the level of that opportunity, and we have a delivery focus now. We have a dedicated delivery head now, and we are also investing in tech, not only in the QSRs that we've just described, but also in the core stores as we open them, in order to deliver the same experience of food in store as you get at home. The next point I'd like to mention is the inflationary risks are greater, obviously, as we've been well reported, but we have been able to materially mitigate those to the end of 22. Utilities, price and volume is mostly hedged, particularly gas, until the end of 22, and additional hedges immediately prior to the Ukrainian crisis came into our gift and was a benefit to us. In food and beverage, most is contracted for the medium term to year end, and when I say food and beverage, I'm talking about the big staples around protein, where we've got both supply guarantee and price guarantee until the medium term as described. And then lastly, on logistics, I think logistics have come back to norm now. We're certainly having no delivery issues like we were facing towards the end of 21. Staff shortage, we've proactively managed to mitigate any negative impact on the ability to trade. And in fact, the quality of applicant now coming through is far, far stronger. So that is the current trading environment. And I'll pass on to Alan for the time being to take you through the financial overview.
Thank you, Robert. In terms of the results summary, as you can see in terms of the numbers on the right-hand side table, I think the key thing to highlight is what Robert made mention of, where since the middle of July, sort of the so-called Freedom Day, dine-in in particular has improved significantly. We also sort of made an announcement in early January, or the middle of January, about the December trading. We were very concerned going into the December month. The guidance and the indications were certainly slightly grim, but we're very pleased to say that we were only 8% down against the FY19 comparison for that period. The EBITDAs, both FRS and IFRS, you can see substantial improvements. We're particularly pleased about this because obviously from this comes the cash generation that we're seeking. This does include, and also equally the revenue, even though revenues have remained substantially below the FY19, you can see that we've been able to convert revenues into profit at a much greater ratio. So the adjusted EBITDA margin under FRS guidance of 13.5%, I think it's important to note that that is ahead of the 11.8% that we actually delivered in the FY19 period, and that's with substantially reduced revenues. Yes, we did benefit from government grants, and yes, we did benefit from landlord concessions, but certainly I wouldn't take away some of the success of the team on the floor in the stores. In terms of the group loss, a small loss being recorded for the current FY21. This is related to the demerger and listing costs. This is obviously a non-recurring cost, so as we move forward into future years, we'd like to see that group loss become a group profit now. Robert made mention of the reduction in the net debt. Very pleased. This has all come from sort of cash generated from the business. And I think it also goes hand in hand with what we'd promised previously, whereby we wanted to set the business up to allow us to consider opportunities, be they organic or they be expansionary. And I think that we have done. In terms of a highly cash generative business, as evidenced by the right-hand side, and by nature of the cash flows, the free cash flow in particular. And what we're looking for here is the prioritization in terms of capital allocation. So we've listed the three things that we see as most important. The first being the opportunity for organic growth, and Robert will deal with that in greater detail as we move through this presentation. Secondly, the selective acquisitions. We are in discussions with a number of parties about possibilities there, so we'll see where those develop. And then thirdly, in the absence of the first two, obviously some investors have indicated a preference for some form of dividend return. We will consider that at the appropriate time. Thank you. So in terms of the cash flow, as I've mentioned, very strong in terms of the operating activities, good improvement on the FY20. The bit that I really want to highlight is the second item, which is the movements in the working capital. What's important here is that you can see that we've actually unwound a significant amount of our accrued debt as a result of the pandemic. So the HMRC obligations that we have now fully unwound by the end of January. And with regards to the payment of arrears rent liabilities, as we've continued to execute landlord concession agreements, there we have also unwound a substantial amount of debt. We do have a small carryover in terms of landlord debt. It's in the region of £2.5 million, so it's certainly not significant, and we remain engaged with the remaining landlords to see what we can do in terms of concluding discussions in that regard. The CapEx program, £4 million, not significant in the year itself. We've tried to be prudent, we've tried to be conservative, we've tried to set the company up so that we can actually take on the opportunities which we think will come to the fore in the near term. Hence, we are not an excessive amount of CapEx there. And that's been largely focused on the new stores which have opened. Financing activities, I will go into a little bit more detail in the next slide, but the most significant thing here is the revolving credit facility that we have under our new banking facility. And at this moment, I'm sitting at the year end, we had £20 million of headroom. I'm very pleased to say that today I've actually instructed the settlement of another £5 million on that from the existing cash holdings that we have in the group. So we've now just increased that back to the full £25 million. And that sets us up, I guess, in terms of the liquidity position. Not only does it protect us from any risks that may come in the short to medium term, but it also provides us for the expansion that purpose of hosted for. In terms of the net debt, it's really just to highlight here that net debt has reduced significantly, as Robert made mention. We're very pleased about this in the way that this has come about. Not only on that, you can also see the lease liabilities on the right-hand side of the table. You can see those have reduced as well. We are being very successful in terms of our discussions with future opportunities, and Robert has a slide which will give some indication on that. But that is obviously something that is core to our focus to ensure that the obligations on the go forward are maximised for the shareholders. The last thing I'd like to just mention here is in terms of the debt to equity percentage or ratio at 0.3 times. We recognise this is very low, and questions may be asked about what to do with the cash. I made mention to that in an earlier slide that we are setting ourselves up for some expansion. In terms of medium-term guidance, a brief indication as to how we see the year and the medium term. Firstly off, we look at about 7 new sites per year, not different to what we presented previously. Possibly the one difference here is that we are already committed to 6 sites for FY22. So there is an opportunity, obviously, as we go forward, should appropriate sites be identified, we may accelerate that if that's appropriate. The second thing is to highlight that there are a number of stores that we have been working our way through in terms of disposal. We had highlighted that on a previous conversation. One of the stores has now closed, and we're in the process of just removing fixtures and fittings from the site and handing it back to the landlord. The second site is still under discussion, and hopefully we'll conclude that in the near term. In terms of the EBITDA margin, we had indicated previously that we were seeking to deliver a mid-teens EBITDA to revenue result. That remains our ambition. This will partly come through the volume growth in terms of revenues as the group expands, and the fixed costs will then be spread over a wider revenue. So that will have a benefit. What I would like to also say in terms of the margins, Robert made mention to the fact that we'd hedged our gas and electrics. So whilst our gas is 100% using FY19 volumes up to December 22, our electric using FY19 volumes has remained at 100% up until the end of March 22, and then it increases now. We've moved from 57% up to 80% in terms of the summer period, which is from April through to September 22, and we've increased the winter which is October through to March 23, from 50% to 70%. Finally, if I can, it's just the CapEx. As we've set out previously, CapEx remains unchanged in terms of our approach to how we intend to invest in the business. The 1.25% to 1.75% remains exactly the same. And the only new piece of information there is the Fridays and Go, whereby we're indicating this will be in the region to £300,000 to £400,000 per store. At this stage, if I could hand you back to Robert.
Thanks, Alan. So if I can just take you through our rollout and expansion strategy and elaborate on that a little more. I'd just like to cast our minds back to our CMD and our prospectus about our strategy. We named it our 4D strategy, which centers around dine-in, delivery, digital to home, and drive-to. So on the rollout and expansion strategy, expansionary growth will come through organic growth of circa and targeting about 7 sites annually, as well as the acquisition and focus on disruptor brands seeking investment in capital to join the HOSTMORE platform. This provides a unique opportunity for organic expansion, both for Fridays in high footfall locations, providing the deal is right, and that at this moment in time is coming with quite handsome landlord concessions and capital contribution. 63rd and First targeting affluent towns where there's young professionals and universities across the UK and the university student. And also our QSR concept, being trialled in Dundee, as already mentioned, will enable rapid rollout across the wider UK with new venues. There is obviously the opportunity for us, particularly in the marketplace, as we see the March quarter end, where there is material risk for underfunded businesses due to the combination of the rent moratorium ending, the VAT rate change, the business rates discount expiry, as well as, and finally, the national minimum wage coming through to bear. Our organic growth strategy, the 4 stores that we opened in 63rd and First was obviously Cobham, Glasgow and Harrogate, and in our Friday stores in Lincoln. We've 6 stores scheduled for FY22 for 63rd and First in Edinburgh and Cambridge, in Fridays, Chelmsford, Barnsley and Durham, and Fridays and Go in Dundee. But saying that, there is a very strong pipeline in all of the acquisition sites that we're looking for each of the brands. So there's no shortage of sites, but we're very focused on what that deal should look like. In other words, if it's a distressed situation, we're not paying, we would pay nil premium for that site. We'd look at quite elongated rent-free, and also capital contribution from landlord would also need to be considered in that. The rent cost to revenue for the new sites for 22 is projected at 4.9%, far greater than the overall core estate, which is running at about 11.8%. Just a quick snapshot of the stores that we opened in 21. On the left-hand side, you see our new Glasgow store of 63rd and First, our Lincoln site for Fridays, and our Harrogate site for 63rd and First. All 3 came from distressed Italian situations. So Glasgow was a Gusto, Lincoln was a Carluccio's, and Harrogate was an Ask Italia. So continuing our transformation and our evolution, and remember that we when we came to the business in the tail end of 19, we undertook a series of consumer research activity along with oyster catchers. Spoke to 3,500 consumers of what they thought of the Fridays brand, and the 3 main pillars that came out of that on the right hand side that became the foundation for our 4D strategy was the need to look at the quality of our execution of food and the quality of the food at core itself, our relevance in the marketplace, and also to simplify the offering that we had, because it was simply too wide ranging and we weren't able to execute it as well as the customer had wanted. So we've taken that 3 main pillars. We've now executed that within the business. It's across all stores now in both brands. As well as that, we want to look at further digitalization of the business. We introduced CRM back in 2020 to engage with our loyal consumers, and we want to improve on that, hosting such things as social studios. So we are really integrating our whole social media network through our customer experience online. We centralize reservations, taking all store reservations away from store and into a central point where we could look at key metrics of capacity management, yield, dynamic diary management, both day of week and time of day. And then also with that comes a more personalized guest service. We look at the quality of our menu offering, improve the quality and the range of dishes. And on the end of this month, prior to the requirement by government to put calories on every menu, which we will be doing, we will see a new range of dishes, Tex-Mex coming back as a feature, known as Fridays of Old, coming back onto the menu. A vast range of vegan options, over 10 dishes for vegan and meatless offer, particularly centering around our best-selling dishes, but in a meatless form, and also in our drink side, alcohol-free and low alcohol and low and no alcohol within that as well. With all that in our radar, we also looked at reducing unhealthy content such as saturated fat, salts and sugars. And just for an example, in our frying oil, we moved to rapeseed oil, which has got a reduction of saturated fat of 27 grams down to 9 grams of saturated fat. We did similarly in reduction of sugar in our JD glaze, which is a very big part of what we sell across the piece. And we're focused on meeting government and actually support the government calorie display guidelines, which will come out on the same menu. So a lot going on in the same thing when that menu is launched. Our IT development includes tabletop, which is, you can see in the picture in the bottom there, that is being able to order and pay at table. We've trialed that in 63rd and First and are going to take it over into Fridays, in a trial first of all, and then across Fridays entirely. We've seen quite an impact on spend through the simplicity of pressing buttons for what you would like, but also we capture AI and we can really map your last journey with us to your next journey with us through QR code technology. There's been a substantial improvement in our health and safety practices, which has led on to a real ESG focus, which circulates not just around nutrition, but also energy and our goal to be net zero. The introduction of a UK-wide retail drinks offer to home. We have now secured, as well as our master franchise agreement in the UK, we've now got an agreement for a retail drinks to home agreement from the US, which now enables us from Q2 to take a whole range of branded drinks, from Prosecco to wine to beer to batch cocktails, and be able to sell them to home via the likes of Amazon, drinksupermarket.com, and most importantly, Ocado. So we're looking at that as a new incremental revenue stream, along with what we're already doing. And then lastly, the investment in our outdoor store frontages, our patios, being enhanced to cater for alfresco dining, which are all set up, both heating, lighting, comfort, and just aesthetic appeal from the street. We look forward to that really coming to fore and bear this summer in July and August, where Fridays has got a great opportunity to grow in that particular time of day and time of year. On the people, environmental and social governance, the recruitment and retention of talent remains important. As I've maybe mentioned in the past, we had a substantial amount of applications, over 53,000 applications for jobs since May 19 and growing, and the quality of that application is improving by the day. We've enhanced our senior operations team. We brought in our new COO from the casual dining world and was formerly MD of Las Iguanas, Julie McEwen, and we've also brought in a specialist QSR regional director to run the new QSR Fridays and Go proposition. We've invested over 4,000 training hours since reopening in May 21. Really important that when new staff join us, given the amount of churn that we had because of COVID, that they really understand the Fridays ways of working. And then lastly, and probably most importantly, unlike many, we give 100% of our trunk, our gratuities to our staff monthly, which means they enjoy a pretty much enhanced wage because of the contribution this makes, and that goes down well in terms of retention and hiring of new employees. We've introduced a new pay award scheme, obviously becoming a listed company now. Long-term incentive plan from all of our senior managers, from general manager upwards, are all now shareholders in the business. And we've invested heavily in professional training of our head chefs. It's not all about what you get paid in the hour. It's also about what we teach and how you become a better person and better chef in the kitchen. We've got that sponsored by HIT, HIT Training, and it's all revolves around our Sparks program. And that's helping us hugely in terms of retention and attraction of new talent. We've seen substantial improvements in environment and social, ethical supply. Particularly 100% of our suppliers will be on the SEDEX register by April 22, where we understand exactly where each of our animals that we eat, our birds that we eat, are being sourced from. We've also signed up to the Animal Welfare Better Chicken Commitment, which is the ethical slaughter of poultry. And we are buying red tractor chicken and quality assured beef now. So that's all part of the quality, but also part of the compliance and diligence that we need to have in the marketplace that we're in today. We're also reducing, we're targeting reduction of our in-house use of gas and electricity by 10% with our green mission, which has been launched across the business and is really beginning to get some traction now. And we're very excited about that. And more nutritional menus, lower fat, salt, calories disclosure, all ready for the 25th of March. And that also includes a new children's menu that we launched on the 8th of February. So, you know, all parts of the family are dealt with in that one. And then material investment in risk and compliance and internal audit function. We felt when we took on the business that wanted its own department, working with all the different authorities. And, you know, we're now in a very good place in terms of ratings around health and safety, food hygiene and fire risk assessment across all pieces, as well as internal audit and cash management within store. So that really takes us to my closing remarks and looking to the future. So we hope today that we've demonstrated a strong maiden result for the year under what has been unprecedented and very difficult trading circumstances that's been perpetuated by the Ukraine crisis. Improved food quality and service standards reflect by consistent guest satisfaction scores. We are seeing a really strong result in that since we launched all our new product in late August of this year on a consistent basis, and probably as a consistent basis has never been so high. And that provides pricing flexibility and opportunity to grow market share. In a recent deep dive survey by CGA, we came out as one of the strongest, in fact, second in the market to the high value customer occasion. And therefore, if we're able to continue that high level of satisfaction to guests and the consistent guest scores that we're receiving, then there is more opportunity for us on price, which in this market is very, very important. The new revenue channels will support dine-out ratio, the retail beverage sales to home commencing, as I said, in Q2 to the aggregators of Amazon, Ocado and drinksupermarket.com, give us a meaningful new revenue stream. Fridays and Go, the trial in Dundee, will be interesting to see how that works. We will know very quickly, we believe, and we'll really like the look of this capital light and rapid expansion brand that we've created, sub-brand we've created within the Fridays stable. And given our low penetration in the marketplace across the UK at 34% versus some of our comp up at 78 and 80%, we see this as a huge opportunity to take Fridays to more places in the UK under the QSR umbrella, where we can do delivery and click and collect from store, we can do dine-in, or we can do takeaway. And you've seen from the video, it is a high quality, very authentic Fridays proposition. Our cost mitigations includes the gas and electricity substantially hedged, which I've described and Alan's described, and the food and beverage substantially contracted in terms of its quantum right through to December FY22. And finally, on looking to the future, our low leverage plus liquidity headroom significantly counters risks and will continue to fund expansion, which is really what the whole premise of HOSTMORE is about. So I can take you just finally to the outlook. And the outlook, we recognize the uncertainties regarding COVID-19 whiplash and absolutely the Ukraine crisis and the potential impact on both consumer demand, the consumer squeeze at home, and the inflationary cost environment in general. But we, however, remain very positive given the strength of our balance sheet and the cash in bank and the demand that we're still enjoying. Further investment in digital, supported by improved guest satisfaction scores, will provide the basis for improving revenue per customer, and the general customer experience, as well as the online experience, the user journey, and in building our cyber relationship, which is important for many of the channels that we've discussed today. Our balance sheet strength and liquidity headroom provides flexibility for expansion via organic growth and the acquisitions that we've described. Our strong cash generation to support our capital allocations framework will prioritize expansion and the introduction of an appropriate dividend policy as time goes by and in due course. And we seek to maintain a net debt to EBITDA range of between 0.75 and 1.5 multiple adjusted EBITDA. I would like to thank you today for joining us. It's no doubt been a roller coaster over a maiden year for us, but it has yielded a great maiden result. I will now open the floor to Q&A.
That's great. Robert, Alan, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Alan and Robert take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Robert, Alan, as you know, we had investors had the ability to pre-submit questions, and obviously you've received a number through today's meeting as well. So perhaps if I could just hand back to you to read out those questions and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Thank you very much. So if I start with Mark Downs, your question from
Steve.
Steve Oram. Sorry, I beg your pardon. What is being done to promote the HOSTMORE brand in the investment community? Many people I speak to have never heard of HOSTMORE, but no Fridays. I feel the shares will suffer for another 18 months until the P&L has 2 years performance, until we do something about the brand. Absolutely very fair point, very fair question. We are working on that. We're beavering away in the background on that now. When you're in the thick of these flotations and you're rebranding and so on and so forth, you've got to make sure you articulate that HOSTMORE is the new home of Fridays. There is a plethora of work going on, and that will be announced very soon. We're working with a couple of agencies on highlighting that. And I'm sure when people hear of HOSTMORE in the near future, they will synonymously know that it's Fridays and vice versa. So just to give you reassurance, that is absolutely happening. The next question, if I may, is the first time I've seen Fridays and Go. Looks fantastic. Can you expand on the planned rollout of the brand, cost of the store fit out, and what types of locations you would think for new sites? So we have to test it in Dundee first. And as I said, this we don't think that will take long. We're very excited about it. We think it's nimble. We think it's agile. We think it's the one that can get us out there quickly or relatively quickly to break into that 64% white space that we are not present in within the UK. Depending on the size of store, Dundee is probably as big as we'll go. It's 2,400 square feet in ground. We are looking at 2 more stores at the moment. One's 1,200 square feet, and the other 1,600 square feet. So depending on size will depend on cost. But let me just put it this way: we could get a situation where for every 1 core brand store, we can get 3 or perhaps 4 of these stores rolled out there. In terms of where can it go, we think it can go almost anywhere. It can go into smaller towns where there is good footfall. But one of the things that is very interesting at the moment is the change in how people are fueling their cars. So we think EV and motorway service station and generally those type of environments could also be an opportunity for us. Hence, it really falls into the fourth strand of our 4D strategy of drive. So we see this as very much a drive-to destination, as well as potentially in smaller town centres where you've got substantial footfall. So I hope that answers that question, Simon. The next question I see is, thank you for your presentation. Can you comment on your midweek daytime fall? Do you think there's fewer, more work-orientated business customers now? We have much more working from home. There's no question. It's patchy up and down the country. If you look at if you look at what's happening at the moment, for example, in our Glasgow store on 63rd and First, the lion's share of its revenue is coming in on Friday, Saturday, and Sunday, and it's somewhat, it's big number, and you're seeing Monday to Thursday quite light. Now, in that particular location, the Scottish government have said don't come back to work yet. We'll wait till the face masks are off. Whereas if you see London and some of the big metropolitan towns such as Birmingham and Leeds and Newcastle, you're beginning to see Monday to Thursday business beginning to come back to some level of meaningful size. The downside of all of this is until we get back to work, and there is some voice to get back to work on a 5-day basis. You only have to listen to the cab drivers in London to hear that nothing happens on a Monday and a Friday anymore. It only happens Monday, Tuesday, Wednesday, Thursday, and Thursday's the big one because it's the new Friday. Is obviously going to be until that happens. It's going to be difficult, but it's not massively marked, and there's no question that the leisure consumer is definitely out in droves in the 3-day market of the weekends.
If I could take the next question, is with regards to what extent do you feel that the VAT back to 20% is a significant tailwind for 2022? I'm not sure tailwind was meant, or maybe headwind, but I'll answer the question as I understand it might have been intended. There's no doubt that the change will have an impact. I think what we're very pleased about is that we have considered this, and we are partially recovering that by way of a price increase as at the end of this month as the new menu goes out. I think what we have been very sensitive to, and we've said it before in presentations, is the customer shouldn't just see a new menu going out, the same menu going out with an increased price. So what we're giving the customer is something that is better value, which will enhance the experience so that the customer doesn't feel negatively affected by spending that little bit more. I think there is still an opportunity. Robert had made mention earlier, CJ had given us some guidance in terms of our pricing flexibility. So depending on how circumstances trade, we will reconsider price increases, but at the same time, we're also just being very measured in terms of making sure that we are fully aware of what our competitors are doing as well. What's most important for us is retaining the customers that we have, developing their experience, and growing thereafter growing customer base. I agree that there is a stock overhang. Can you elaborate? Yes, my understanding is I agree with you. I think that a lot of the share trading which is taking place is sort of the 20%, the smaller 20% of the stock which is owned by investors. A lot of the share transactions which are going through are fairly small amounts. I think this is unnecessarily having a bearing on the price and the perception. I think if I look at how our key investors are responding to us, I'm very, very pleased in as much as that the top 20 investors hold 80% of our stock, and they are absolutely rock solid behind us. There's only one investor which has indicated willingness to sell down, but they have remained engaged with us as well. So I'm very positive that as time goes by, I believe that the share price will stabilize, and then as people get to see the underlying trading results and the strength of the balance sheet, I believe there'll be a re-rating that'll take place for that.
When did you contract your food and beverage spend for 22? That was probably done in between August and September, October of last year. We've been here 35 years in the UK with Fridays, so we have long-term relationships with our supply base, which is UK based but reaches all over the world for supply. And we definitely, particularly around certainty of stock, we bought very early on, or gave volume commitment sort of third quarter of last year to those long-standing suppliers, and therefore we were able to secure what we did then for the whole of 22. And we even went as far as one particular supplier, which is not close to home, actually opened up another factory for us somewhere closer to home to make sure that they were able to supply our needs. I'm just reading one here. Do we employ secret shoppers to target branches with the worst customer reviews? It's something we don't do. We work with a mechanism called Feed It Back, which is not only on NPS but also on guest opinion score, as well as it aggregates what all the Googles, the TripAdvisors, and so on so forth say about us. We're pretty proactive in that area now, and we aggregate all those results and put it into one place. It's a Feed It Back score, and that's alive and kicking in all of the stores to make sure that the team are engaged with the guests to make sure we're getting the feedback that we want, and we're getting the levels of feedback to give us a meaningful score. Could you comment on the differentiated prices between the new CSR format and the classic Fridays? So what is the difference in the price between, say, a burger at QSR versus Fridays? Okay, so the burger product is the same product in a smaller format. The garnish is exactly the same. So what you're getting in Fridays is in Fridays core brand is exactly what you'll get in Fridays and Go. In terms of the pricing, the pricing has been done with a safari of 5 or 6 QSR burger providers, for example, in that particular food type, and we've looked to price ourselves between the lead in the market in terms of price and the mid market in terms of price. So we did an analysis across the UK and then specifically on the region that we're opening in, and therefore we think we're priced at the same level. And there is obviously a slight difference in margin between store and QSR, but we believe the pricing is right for that market. And we have, the great thing about this is we've got the ability to change price at any part of the day, at any part of the time, almost instantaneously, if we see demand changing. And the data will tell us that we can change pricing and bundling and packaging of burgers with fries, with drinks and meal deals and all that sort of stuff. We can do, when the data starts coming, we can change that instantaneously, particularly around time of day, and we can see all the margin changes by doing that. So we make sure we're protected. So it's a very the technology element of Fridays and Go is probably about 25% of the overall investment in any given store on the first fledgling store, because we've taken the technology of one of the biggest. But we've adapted some of the outputs that we require from that on data to dovetail it into our own CRM, so we can understand the guest profiling and time of day use, so we can price accordingly.
Thank you. The next question is, what is your range of EBITDA margin expectations for this year and in the medium term? I think if I can go back to what I said earlier, FY19 we delivered just sub 12% EBITDA margin. That's on FRS accounting through to revenue. Last year we delivered 13.5. Previously we'd indicated mid-teens. I think the most important and positive opportunity that exists for us is that over the past year, 18 months, working with our landlords, working with other various parties who are largely fixed costs in the business. Robert had indicated sort of our success in terms of new sites which are opening at a rental level of sub 5% relative to projected revenue. All of this provides us with a very good opportunity should we be able to grow demand. Therefore, with only the variable costs attributed thereto, that will support an improvement in the margin. So I think there's a lot of opportunity, provided that we are able to continue growing the demand as we are seeking to do, for margin to improve as we move forward. But the mid-teens is the range that we have given.
Okay, thanks. Matt G, your first question, what's the split of revenues between the four Ds? I mean, obviously dine-in and particularly Fridays, obviously so its size versus the fledgling brand of 63rd and First, 90+%, 95% of our total business comes in from Fridays. Our revenue at delivery level it hovers. Obviously, at one point it was all of our revenue in the middle of COVID, but it hovers around 4, sometimes 5% of our total business, and it's an area we've invested in terms of people and in technology, as I said earlier, and we've got an aspiration to double that by the end of the year. My views on the estate size potential of each of the brands longer term. We have got a development obligation with the US on the core brand. We have to open 9 new stores by the end of 24, of which by the end of this year we'll have opened 5. So we're well within reaching that number, and we'll probably exceed that number. I see Fridays in the short term, and I mean the next 3 years, the Fridays core brand being hovering around the 100 mark in terms of stores. 63rd and First, we would like to see in the next year, a calendar year from sort of mid-year this year to next, to be up to either acquired or opened 10 stores. But the real unknown and the real ambition or the real opportunity, we think, is around Fridays and Go. And there's nothing to say if Dundee's successful and we do 2 other sites that we're looking at in the villages of of the right demographic in London, we could see this brand getting to up to 30 stores over the next 3 to 4 years, or maybe even more. But we have to prove the first one, make sure the margins are right, make sure the revenue's right, understand the day parts, and then take it from there. So I cautiously say on Fridays and Go, we've got high hopes, but Dundee will have to prove itself first.
I think that's largely answered.
And I think I've just answered Michael D's question on what I've said there in terms of 9.7 years.
So the average tenure is approximately nine and a half years. Practically, as we sort of go forward in terms of what we'd like, as we move forward, I mean, we would obviously like to reduce the fixed cost, regardless of whether it's rent or another cost, relative to the revenue, to give us some sort of flexibility should revenues move around or increase or decrease. So we have no absolute ambition. I think what is very important is through the pandemic, what we have done is in our discussions with the landlords, we've actually secured extensions of certain sites. These generally are very profitable sites and contribute to us. So we've given the brand certainty of the future. We haven't necessarily always got it at a reduced rent, but we have negotiated rent-free periods as part of that contract as well, or the deferral, for example, of the actual rent reviews from existing rent reviews, which might take place within the next 5 years, to push them out to past the 5 years. So what we've tried to do very, very much is, as we grow the revenue in the near term, we would expect that rental cost to come down sub 10%. And the absolute target we have not set in our minds, because it's going to be driven by how well we do on the revenue.
On your next question there, Matt G, when are you in the investment cycle? Where are you in the investment cycle current estate? I.e., when do you need to refresh? How many sites was it a year? So prior to us arriving here at the end of 19, we had an obligation by the US to open 5 stores a year. So from 17 through to 19 to 20, there were 5 stores per annum being opened there. So the estate is actually relatively young in almost 35% of it. We have divested or we have offloaded 2 sites to date that were required of large capital expenditure. And we have this year, as Alan's let you know the number, we have 2 sites, particularly where we're going to go in and do some what we call a sparkle in terms of investment. But actually, generally, the number that we have in the forecast going forward in terms of capital investment in the current estate, we think we can get pretty much keep our estate in the good shape that it's in today. And it mainly centres around aging bathrooms and aging floor finishes and so on and so forth, and obviously kitchen investment. And we've taken a long look at kitchen investment because of utilities, and particularly moving to more electric in the kitchen. That's where that ongoing investment will be. But we believe we've got enough fuel in the tank to keep the business looking pretty good, considering the amount of new product we have against some of the old. And where we won't invest is where we're coming to the end of 10-year on lease, which we've only got about 2 or 3 more by the end of 24, which is where we would exit those anyway.
Robert, Alan, I think you've been very generous, and I think you've answered every question from investors. So thank you once again to all those investors that have taken time to submit questions this afternoon. Robert, Alan, I know investor feedback is important to you both, and I'll shortly redirect investors to provide you with their thoughts and expectations. But before doing so, I wondered if I may, Robert, just ask you for a few closing comments to wrap up with.
Yeah, I mean, I appreciate the candor of the questions. We appreciate your time this morning. It's a busy market out there, a very volatile situation with the Ukraine war. But thank you for joining us. For us, it was a roller coaster maiden year, but actually a maiden year that yielded a great result. So thank you for all your time this morning.
That's great. Robert, Alan, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of HOSTMORE PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.